Look, just because you're self-employed doesn't mean you don't deserve a good loan or that you should get secondary financing. And now often when it comes to those of us that are self-employed, well, we like to take advantage of our God-given American tax write-offs. And with that, often our income doesn't, well, look as good as it should on paper to qualify for the traditional bank loans. Now, when that happens, know that there are other options. See, for those of us that are self-employed, there's loans like bank statement loans. There are loans like profit and loss statement loans that are available to us. There are also asset-based loans that are available to us. And then lastly, CPA loans. Now, each of these works a little bit different, but really kind of all the same. And see, if your tax returns don't reflect the income that's necessary for you to qualify for the loan, your alternate loan is going to be based on, well, how much cash flow is your business bringing in and how much money are you retaining each month? And when it comes to the bank statement loans, you really have one of two options here. You can show personal bank statements or you can show business bank statements. Now, traditionally, should you choose to show personal bank statements, you're going to show 12 months of bank statements. And then if you choose to do business bank statements, you'd show 24 months of statements. And in either scenario, what's going to happen is the total deposits are going to be added up for each and then divided over that timeline. So for example, let's pretend you're going to supply 12 months of personal bank statement. These 12 months of personal bank statements, all the deposits are going to be added up. And just for simple math, let's just pretend they come out to $120,000. That $120,000 of total deposits is now going to be divided by 12, and the income that you're going to be receiving monthly to qualify for the loan is going to be $10,000 a month. How did we get that? Very simple. $120,000 divided by 12 equals $10,000 a month. Now let's pretend that we're going to use your business bank statement. So instead of providing the 12, as we just mentioned on personal statement, you're going to provide 24. Now, same formula. Add up all the deposits of all 24 months. Now, for simple math, let's just pretend that's $240,000. We're not going to divide the 240 by 24 months, similar to how we did with the personal bank statements. Instead, we're going to take the $240,000 from our business deposits. We're going to divide that in half. That's going to give us $120,000. We're then going to divide that number by 24 months, which is going to give us $5,000 a month as monthly qualifying income. Why is that? Well, because when money goes into your business account, we have to factor for certain expenses that your business is naturally going to have. When the money goes into your personal bank statement, well, then that money is looked at as it's 100% yours. So that's how bank statement loans work. And if you're self-employed and you don't quite qualify just yet based on your tax returns, first, I recommend that you have a local independent mortgage company take a look at your tax returns, because believe it or not, there are so many of us out there who are self-employed home buyers who qualify based on our tax returns, because there's many deductions that we take that are actually able to be added back in as income. And when you're working with a traditional bank or an online lender, they simply don't get it. And when they don't get it, you don't get it. And what you don't get is a great loan for you. So the first thing you want to do as someone who's self-employed is have a local independent mortgage company look at your tax returns. If you're here in the state of Texas, we would love to take a look at those. If you're outside of the state of Texas, well, we can point you in the right direction. Next, what I'm going to do is talk about profit and loss and CPA loans, as there's, well, some self-employed home buyers out there don't have 12 months of personal bank statements, or maybe not have a 24-month history of business bank statements. Instead of that, what you can do is you can have your CPA prepare a profit and loss statement for you. And that profit and loss statement is what's going to be used as income to qualify for the loan. Now, there's a catch here. The CPA that prepares your profit and loss statement has to be the same CPA who's prepared your last 2 years of tax returns. So again, if you're self-employed, you can look at bank statement program loans. You can also look at CPA and profit and loss statement loans. And then lastly, this is for you self-employed, or even if you're not self-employed and you just have a bunch of cash sitting in your bank account or in a retirement account or in a trust, you can actually use the assets that you have as income. And the way it works is really, really simple. Are you already taking distributions? One, if you already are, great. How much is it? And do you have a 3-year likelihood of continuance? If you're not taking any distributions and you're saying, Paul, I don't know what that means. I just have a bunch of money sitting in a checking account or again, a retirement account. How can I use that money as income to qualify for a loan? Well, in the most simplest terms, you set up a trust, and the trust is going to pay you. And so long as that trust has a 3-year continuance of income or more, the income that the trust pays you is qualifying income for you to obtain a loan. So let me say that all differently. So let's pretend you have $500,000 that's either sitting in a checking account or sitting in a retirement account. What you're able to do is set up a trust and receive income from that trust. So we're going to take that $500,000, we're going to put it into a trust, and that trust is now going to pay you $10,000 a month. If you rewind this video a little bit, you're going to hear me say that you need a 3-year continuance of that income. So $10,000 a month times 12, that's 1 year, times 3 comes out to $360,000. In this example, you have $500,000 in the trust. $360,000 is the 3-year continuance. Therefore, you can use that $10,000 as qualifying income for you to obtain financing. Now, you don't have to be self-employed for this to work. So let's pretend that you're marginally qualified or that you're marginally disqualified. What you just heard here is that you can set up a trust that pays you the income that gets you over the hump of qualifying. So I hope this video was helpful. If you ever have questions, please think Blake. We have tons of videos on our pages, so I hope you enjoy them. And if you ever have questions, I look forward to us chatting. Cheers.